Hello and welcome to ETF.com's Generating Income series of webinars this week. This is 5 straight days of information and interviews about various pockets of the world of income-generating investments, from building multi-asset income portfolios, thinking of dividends in new ways, focusing on share buybacks and shareholder yield, how to pump up yield in traditional bond portfolios, and finally on Friday, looking closely at the highest yielding ETFs available today. Today's presentation is Dividend Yield versus Dividend Growth, the changing face of dividend strategies. This is a complimentary ETF.com webinar courtesy of WisdomTree Asset Management. I'm Ollie Ludwig, the managing editor of ETF.com. We are the leading authority on news and data about ETFs and the company behind Inside ETFs, the world's biggest ETF conference. Before we get started, I wanted to cover a few housekeeping items. At the bottom of your audience console are multiple application widgets you can use. If you have any questions during the webcast, you can click on the Q&A widget at the bottom and submit your question. We will try to answer these during the webcast, but if a fuller answer is needed or if we run out of time, it will be answered later via email. That's whether you reach out to WisdomTree or WisdomTree reaches out to you. The point is we do capture all of the questions, so don't hesitate to ask questions. You can also expand your slide area by clicking on the maximize icon at the top right of the slide area or by dragging the bottom right corner of the slide area. Now, if you have any technical difficulties, please click on the help widget. It has a question mark icon and covers common technical issues. And finally, an on-demand version of this webcast will be available about a day after this webcast, and it can be accessed using the same audience link that was sent to you earlier. Joining me today is Chris Gennady. He is the Associate Director of Research at New York-based WisdomTree Asset Management. Welcome, Chris.
Thank you very much, Ollie.
And before I forget, I wanted to congratulate you and your company for winning ETF.com's ETF of the Year award. That was Hedge, HEDJ, the WisdomTree Europe Hedged Equity Fund. This is a $16 billion ETF that is on a tear. It's gathered more than $9 billion in assets this year. And it's known mostly for its currency hedged, but its index also emphasizes dividend-paying firms in the Eurozone, and that makes Hedge a nice segue to today's presentation on the finer points of dividend-focused investing. All by way of saying it's great to have WisdomTree participating in our Generating Income webinar series this week. This company, after all, is one of the pioneers of dividend-focused equity strategies. So a chance to discuss ways to refocus the whole idea of dividend strategy should involve WisdomTree, truly one of the pioneers of the smart beta movement that is so on fire at this point. Now, from a 30,000-foot perspective, it's a great time to take measure of the landscape of income-producing investments, including dividend-focused strategies. The bond market, after all, is nothing if not anxiety-producing these days. Investors who have played defense since the market crash about 6 years ago in short-dated bonds have had their paltry yields buried by inflation. And investors keen on getting yield in this bond market environment have taken on duration risk or credit risk in corporate bonds or in the emerging markets. All these choices have risks, as the bond market has shown in the past few years, notably during the taper tantrum in the spring and summer of 2013. And now that the Federal Reserve has put the possibility of its first rate hike in 9 years on the table, concerns about capital losses in the bond market are again in sharp focus. Given the real risks and challenges in the bond markets, equities that shoot off attractive dividend streams have rightly come into focus since the 2008-2009 market crash as a way to help investors generate income. But as we'll see from Chris's presentation, there are different ways of thinking about dividends, all the more so at this crucial juncture in the economic recovery following the Great Recession. Specifically, Chris will get into the importance of focusing on companies that not only have attractive dividend yields, but also grow their dividends over time. And in case anybody needs a reminder, among the 70 ETFs WisdomTree now sponsors in the United States, it has about a half dozen dividend growth strategies focused on the U.S. and international markets, including developed and emerging markets. So on that note, Chris Gennady, Associate Director of Research at WisdomTree, take it away.
Oh, thank you very much, Ollie. It's really a pleasure to be here today, and we really appreciate your taking the time to learn a bit about different dividend-focused strategies around the world. The roadmap today is going to be sort of a U.S. introduction and focusing on illustrating some key concepts as it relates to the U.S. equity markets, and then taking a brief tour among some developed international ideas and some emerging market ideas. As we start clicking through the presentation here, what we will be seeing are a few slides that just relate to compliance-oriented issues, namely what we have to do because we're talking about a number of different ETFs, WisdomTree as well as some others. We just have to state that we're doing everything in our power to make fair and just comparisons and present the information as clearly as is possible. So that's really, in essence, what's being said as all the various ETF methodologies are detailed on these slides as we click through them. So as we get to the end of that segment, what we also see is just a look at the standardized performance. This is all available on our website as well as the websites of other providers, just so that people can see how these ETFs have performed since their various inception dates, as well as over the relevant standardized periods, 1 year, 3 year, 5 years, etc. So with this slide, we really start the meat and potatoes of the presentation, and it's an introductory slide that we use in a number of presentations, and it gets to the core of the matter. And you see the 4 bullets toward the bottom, which really emphasize some of the benefits of focusing on dividend-paying equities. One of our favorites, or 2 of our favorites, are corporate governance, especially when you think of international companies and emerging market companies. Companies that pay dividends, I mean, dividends don't get restated. They don't get clawed back. You don't need to depend on earnings assumptions across different accounting standards in different countries. Dividends are what they are, and there is a true demographic need for income, especially in a lot of developed market countries and even some emerging market countries as people get older and think about retirement. But the blue box really gets to the core of the matter in how we believe and how we ultimately construct our dividend-based indexes. And it's basically outlining a point of you have 2 options. You have sort of the market cap-weighted approach, and with that approach, you own stocks in proportion of their market cap. If the price goes up and the stock goes on a run, you have the potential to own more and more and more of that stock, and it might be getting more and more expensive. What we're trying to do, and what you'll see as a bottom line point in a lot of our slides, is we're trying to make sure that if companies year to year are getting greater weight within an index, it's because they're doing something. They're increasing a particular fundamental, and in this case, the fundamental that we're looking at is dividends. If you think of greater weight within an index as a reward, we want to make sure that to get to that reward, the company is increasing its fundamental factor. And again, through this presentation, that fundamental factor is the dividend. So as we look at this slide here, really one of the key questions, it comes up a lot, you hear it a lot on the news, it's probably secondary to hearing about strong dollar, which you also hear a lot these days, is are U.S. stocks starting to get expensive? And that's one of the trickiest questions, and it's a question that seems to come up at the start of every year. And in past years, what's tended to happen is there's a lot of debate at the beginning of the year, and at the end of the year, we turn around and say, wow, that was another great year of U.S. equity performance. Because in essence, since the crisis, in general, the U.S. markets have been strong, and for the last few years, there have really been few, if any, markets around the globe that can compete. Typically, when people are asking whether or not U.S. equities are expensive, you hear a lot about the price-to-earnings ratio. But today, we want to relate valuation back to dividends. And in essence, there are some key components when you look at any index. It doesn't have to be just dividend-based indexes, because most indexes include at least some firms that pay dividends. in essence, what you'll see is you'll see over time the index will have a dividend yield, and that number can be going up and down, and the constituents within the index will be either growing or contracting with respect to their dividends. And the price of the index as well will be changing. And what you see in that orange box is a few systematic quantitative ways that you can use to track how the dividend yield is changing over time, how the dividend growth is changing over time, how the valuation of the index is changing over time. And instead of a price to earnings ratio, which is simply the price per share times number of shares outstanding, you can do a price to dividend ratio, which is the price per share over the dividend per share. So instead of being divided by the earnings per share, you're dividing by the dividend per share and relating price directly to the dividend level. What you ultimately see when you think about what the return of U.S. markets has been over the last 7 years is you see the red column. And the red column is the average annual return of the Russell 3000 index over the last 7 years ended December 31st, 2014. So the red column is what everyone knows going in. And the blue, the orange, and the green are essentially the drivers that get you to the red column, and they explain different things about how you achieve the 7.45% per year on the Russell 3000. And of course, starting from the left, the blue bar is the highest. That's pretty clear. What is the blue bar? The blue bar is the average annual dividend growth, specifically the average annual dividend per share growth, looking at dividends of the index on a trailing 12-month basis. So you see that the primary driver of how you got to 7.5% return per year came a lot from dividend growth, more than any other factor. The valuation change is such that it's basically as though you're thinking of how the price to dividend ratio changed over that 7-year period. And if you think about it, we know that the price component has been going up because, of course, U.S. markets have been doing very well. But you know, because of the blue bar, that the dividend component is also growing. And really the question is, which grew faster, the dividend component or the price component? And the negative 0.32% per year is telling us that even with the price going up, the dividend growth has actually been faster. And in essence, even in an environment where you essentially had good price growth, you had better dividend growth, and on a price-to-dividend ratio basis, in essence, the market got cheaper. And we think that is a point that is of exceptional interest today. You, again, always hear about the price-to-earnings multiple. You rarely ever hear about any other valuation metrics when people are talking about indices. The average dividend reinvestment rate, if people want to think about what that in essence is, it's very similar to thinking of an average dividend yield level over the period, and generally it's accepted that the U.S. equity markets today are yielding around 2%. Depending on the index you look at, it might be 2.1%, it might be 1.9%, but the equity yield in the U.S. is right around 2%. And specifically, if people want to know where that number comes from, for any period of time, for any index, you have a price return and you have a total return. And that 2.07% per year corresponds to the difference between the price and the total return. And in essence, it's related to the level of dividends being paid over that period of time for the underlying constituents. So again, very interesting that if you go away from the price to earnings multiple and you look at the market as price compared to the dividends and the dividend growth has been so strong in the U.S., you can make a case that the market's gotten a little bit less expensive each year for the last 7 years.
Chris, I'm going to jump in before you push forward there. You may have just answered the question, but did you mean to say that WisdomTree's view here is that the U.S. market is not overvalued? I mean, what is WisdomTree's view? Is this market overvalued at this point after this great bull run over the past 6-7 years?
I think that's an excellent question. It's the question that people are asking basically every single day. And in reality, valuation is all about which fundamental you choose to look at. And in this exceptionally low interest rate environment, a case can certainly be made that when interest rates are as low as they are today, the average P/E ratio of the S&P 500 maybe should be closer to 19 times earnings than what it currently is. So are we closer to fair value than we were a few years ago? Absolutely. Are we necessarily overvalued? We're not so sure that we're necessarily getting into that overvalued territory. And if you shift to dividends and you say, okay, what does the dividend valuation picture tell us? Because it doesn't necessarily connote the exact same thing that the earnings picture tells us. What we see here for the Russell 3000 is that on a price to dividend ratio basis, the market has actually gotten less expensive by basically 0.3% per year over the last 7 years. It's really a perfect transition to the next slide, which emphasizes the total return of the S&P 500, and you see the orange. The orange really stands out, 20.4% per year for the 3 years ended December 31st, 2014. So that's a remarkable 3-year return. It really shows how strong the performance of U.S. stocks has been. But at the same time, what you see is the dividend growth of the S&P 500 was similarly high. It was almost 3 times its long-term historical average. And what do I mean by long-term historical average? I mean that gray bar that says 5.6% per year, the average annual dividend growth of the S&P 500 going back to December 31st, 1957, essentially the beginning of live performance availability for the S&P 500. So what we basically like to say is we know U.S. equity market performance has been strong, but it'd be more concerning if you didn't see the strong growth in the fundamentals, in this case dividends. In essence, even though the market has been performing and essentially hitting record highs at various points, the dividend stream and ultimately the dividend growth has also been outperforming and growing much faster than the long-term historical average. So we think, given that the fundamentals are in essence supporting this great price performance and great total return, we're happier than we would be than if the opposite was occurring and you weren't seeing such strong dividend growth. It's one of the more exciting parts of U.S. markets, and another way to look at it is you can actually look at it year by year by year, going back, again, all the way to 1957. And if you look at 3-year periods, it's very interesting to just say, if you look at 3-year periods going all the way back, the average 3-year growth since 1957 was 5.5%. So very similar to that long-term average that you saw on the prior page. The latest 3-year average growth is greater than 14%. And similarly amazing and remarkable is since the 2003 tax cut, the average S&P 500 dividend growth is 8% per year. So still a little under 3% per year better than the long-term average, including a 21% drop in dividends in 2009, which since the Great Depression was essentially the greatest single-year drop in dividends that we've seen. So amazing that the average is still 8%, including a single year where things were down 21%. I know a lot of what we're seeing in the news today is things about financials sort of coming back and tech firms, and we're going to get into all that, but it's a very, very interesting and exciting time looking at the performance of dividend-paying stocks and specifically their dividend growth in the United States. So the natural question is, can it continue? Because, of course, if the dividend growth cannot continue, then necessarily the market is more expensive than if the dividend growth can continue. And one of the ways to look at that, and it's fairly interesting to be able to go back to 1871. We do this through the use of Professor Robert Shiller, who publishes this data for the S&P 500 going all the way back. And you can see that from 1871 to 2014, the average dividend payout ratio was in the neighborhood of 60%. But over the prior 12 months, the average dividend payout ratio was about 36%. And from 1946 to 2014, the more recent of the periods, the average dividend payout ratio was closer to 50%. So the general point is that in more recent periods, the payout ratio has been lower. And one reason for this in the United States, and for people who are wondering, how does this relate to, say, an MSCI EFA, which is essentially developed world ex-US, ex-Canada, what you see in EFA is the payout ratio is right around 50%. So the U.S., there's something different that's going on relative to markets around the world, causing there to be a lower observed payout ratio. And what we think, in essence, that is, and what you can actually see it is in 1982, there was a rule, 10b-18, which allowed firms to begin to buy back their shares. And we hear it all the time. We hear essentially share buybacks are even greater than dividend payouts. And Apple's a great example. Microsoft is a great example. Almost every large firm that pays a major dividend also does some sort of a buyback program on the side, and the technology firms are really most famous for it. So an interesting statistic that you can look at, and what the bottom chart is looking to show through the use of the second column from the left, is that the net buyback ratio, which in essence is telling you in terms of the share reduction per year for the particular index, and the index that we're using here is our WisdomTree Dividend Index, you're getting about a 2% share reduction per year for the last 4 years. So in essence, if companies continued to pay the same cash dividend amount, but you had a 2% share reduction, you would have 2% higher automatically dividend per share growth over that next year, because you're reducing the number of shares outstanding year to year to year by 2%. And we definitely think, for reasons of there's so much cash on balance sheets, the companies are, in certain sectors especially, hitting record levels of earnings. In essence, this buyback behavior can certainly continue. And additionally, if firms wanted, they could tilt more towards dividends, and there's a lot of room to take that payout ratio higher relative to where it is today against maybe the longer-term historical averages. So in essence, on this page, you see a low dividend payout ratio, which maybe increases over time, and if it does, that's one way that you get higher dividend growth. The other way that you get higher dividend per share growth, again, thinking it through, if the dividend cash amount being distributed by firms stayed the same, but the number of shares outstanding year to year to year decreased by 2%, the dividend per share growth would automatically year to year be 2% per year higher. So these are two exciting reasons that could point to the potential for continued dividend growth. And if we ask ourselves, are there any sectors that are particularly responsible, or at least more responsible than others, for the dividend growth that has been experienced? The reason that we start this chart in 2007 is it relates directly to the live history of our indexes, and specifically the live history of rebalances for the WisdomTree Dividend Index. And just to give people the lowdown on that specific index, what it is it includes all U.S. regular dividend-paying companies. Last year it was about 1,500 names. There's really no selectivity being applied. It's simply, do you pay a regular dividend? You're in the index, as long as you meet certain liquidity and other requirements. But to have an index of 1,500 dividend payers, you really get a very detailed view of what's going on in the U.S. dividend-paying market. And it's exciting to be able to say, because 11/30/2007, that was essentially the pre-crisis peak. We didn't know it at the time, but that next year, really the next 2 years, in essence, was going to be some tough sailing in U.S. equity markets. And we were really close to the peak at that particular point. Since that point in time, it's remarkable that the technology sector has generated $40 billion in incremental dividend growth. At that point in time within our index, it was really a relatively low sector in terms of representation. A lot of tech firms weren't necessarily paying dividends. But since then, you've seen Cisco, you've seen Oracle, you've seen the blockbuster Apple, which competes with Exxon as the largest dividend payer in the world, really, you've seen incredible growth out of information technology, and you've really seen growth out of 9 out of the 10 total sectors. The only sector that hasn't hit its 2007 level, its November 30th, 2007 level, is financials. It's about 16 to 17 billion off of that level. The orange is meant to
Chris,
grow.
can I chime in very quickly? It's hard to interrupt you again. Are you suggesting there's something different this time? I mean, or otherwise frame the question is depending on past trends, do you risk missing what's happening here and now in terms of this whole phenomenon of dividend growth?
I think that's a rather excellent point, because in essence, a lot of the technology firms, I mean, if you really think about it, Microsoft has been paying for about 10 years at this point in time. So we know Microsoft was one of the first of the major tech companies still in existence today to initiate a dividend policy. And a lot of firms have followed suit, and we know that a lot of tech firms have an awful lot of cash on their balance sheets that they're looking to use for buybacks and looking to use for dividends. So the remarkable thing is it's a very young dividend-paying sector, but it's one of the most heavily weighted and well-represented dividend-paying sectors in the U.S. today. And a mere 7 or 8 years ago, it would have been one of the least represented. So the growth of technology has been incredible, and you're exactly right to point out that a lot of these firms don't have 10-year dividend histories or 20-year dividend histories. The other sector would be financials. I mean, if you think about financials, a lot of the firms until recently, we saw the announcements a couple weeks ago, but in essence, the government came in as a result of the crisis and said you have to cut your dividends. And that was that. So these firms went from being some of the biggest payers to having to really claw their way back to regain where they were in 2007. And you could say it's a healthier place in that they're not relying on the securitization revenues that they were in 2007. And you see that since the low, which is the orange, financials have been the biggest cash grower, essentially almost adding $50 billion in incremental dividend growth. It's really been remarkable what technology and financials have done, but really neither sector, each for its distinct regions, is going to have a lot of firms, or at least a lot of big payers, that have been paying dividends for the past 10 years. So at this point, there's somewhat of a transition, because we start getting into thinking about how different indices are built. We've talked about the market in terms of valuation and what we think could be some important elements of dividend growth, where that dividend growth is coming from. The question is, how do you construct indices to capitalize on these trends? And one thing you have to think about, when you think of indices, there are really two things. There's weighting and there's selection. And if you're thinking about weighting, you can have a market capitalization weighted approach, similar to the NASDAQ US Dividend Achievers Select Index. This is what VIG from Vanguard ultimately tracks. And the market cap weighted approach is scalable, it's representative, bigger weights to bigger companies by market cap. There is some similarity between the Dow Jones US Select Dividend Index and the S&P High Yield Dividend Aristocrats Index, in that one is dividend per share weighted, one is dividend yield weighted, but both of those methodologies, what they tend to do is they tend to sort of equalize the playing field and function somewhat like a modified equal weighted index, in that you wouldn't necessarily see your biggest weights in your biggest firms by market cap. You might see tilts drifting into the mid cap and into the small cap space, because mid and small cap stocks can have high dividend per share, they can have high dividend yield, and they can be well represented in these indices. So it's just important to note that you could see a tilt towards mid-cap and small caps that you wouldn't necessarily see with the NASDAQ index. You wouldn't necessarily see it with the WisdomTree indexes or some of the Morningstar indices, which weight by dividend stream, which is the fourth sort of methodology. And the key thing there is, instead of price times shares outstanding, which you see in the top row, it's dividend per share times shares outstanding. So you're substituting dividend per share in for price to create what we call the dividend stream. which is also, like market cap, scalable and representative. It gives bigger weights to firms paying greater amounts of cash dividends. And that tends to be larger companies. The biggest dividend payers in the U.S. are Exxon, they're Apple, they're Microsoft, they're AT&T. You go on down the list, you're not surprised. You see large major companies in the top 10 and even the top 20. So what you do with this methodology, though, that market cap doesn't do, is you incorporate a tilt towards stocks growing their dividends per share relative to their price performance. It's what we said on one of those early slides. If you think of greater weights as the reward, do you want that reward to go to the guys where the price increased, or do you want that reward to go to the guys where the dividend increased? And we obviously think very highly of structuring it so that the reward goes to those increasing their dividends over time. The other part, as we alluded to, is the stock selection. So you can select stocks based on past trends of dividend growth. And the indices that VIG and SDY and DGRO track all look at some characteristic of past behavior, some backward-looking measure of dividend growth. VIG's underlying index says 10 years, 10 consecutive years. SDY's underlying index says 20 consecutive years. DGRO's underlying index says uninterrupted 5-year dividend growth. So this is all past behavior. And if you think of Apple as the example, which essentially initiated its first dividend since 1996 in 2012, you would see that Apple wouldn't necessarily meet the criteria listed out here for any of these indices in terms of past dividend growth behavior, but it is the second largest payer of cash dividends in the United States. So that's a potential consequence of requiring past dividend growth. You can also select on dividend yield, and you can select, like the index tracked by DHS, you can select a percentage, in this case, the 30% highest yielding dividend payers from across all dividend-paying companies in the United States. Or you can look to these other methodologies which, in different ways, focus on higher yielding dividend payers. It's sort of, do you want the potential growers of tomorrow, or do you want to make sure and focus on the companies that are paying the higher dividends relative to their prices today? Not saying one is necessarily better or worse. It's just you get a very different profile. You get a very different underlying constituent when you focus on growth versus when you focus on yield. And then you have broad-based. And if people are thinking of the idea of, what's the beta, what's sort of the market of dividend-paying companies in the U.S., we really like the underlying index of DTD for that purpose because, again, it includes every regular dividend payer in the United States as long as it meets some reasonable liquidity requirements. 1,500 underlying companies. You have the high yielders. You have the growers. You have them all. And then DLN is a cutoff of that, or the index that DLN tracks is a cutoff of that, in that you get the 300 largest companies by market capitalization essentially from that larger 1,500 firm universe. So 3 different ways to do it. You own them all. You just own the dividend-paying market, and that's it. You focus on growth, or you focus on yield. And there are a variety of different ways to do it. We're going to get into certain tilts that get created depending on which ultimately is chosen. What we see is if we ask ourselves the simple question, we take the portfolio of stocks, and that's really what an ETF is as a bottom line. It's a portfolio of stocks in accordance with certain rules that's tracking a particular index. These are all different U.S. dividend-focused ETFs, and they're ultimately compared to the S&P 500 index. And it's a snapshot in time on December 31st, 2014. And in essence, what you say is, of those constituents within each portfolio, what was the median 5-year dividend growth level of those specific constituents? It's not the dividend growth of the index. Some of these indexes haven't been around for 5 years. It's the dividend growth of the underlying companies, specifically the median dividend growth, going back for 5 years. The underlying companies, in most cases, have been around for 5 years. And so you see that focusing on dividend growth as DGRW's underlying index does, not requiring past dividend growth. That's sort of the key differentiation. It's the only dividend growth focused underlying index that does not require the constituents pay dividends and increase dividends for a set number of years ahead of time. VIG, DGRO, SDY, they track indexes that, as we saw on the prior page, essentially require past dividend growth behavior. So it's interesting that the 5-year number for DGRW looks very different, really, than almost anything else on the page. DGRO is the only other, or excuse me, DHS and DGRO are the only other two in the double digits, and VIG as well, excuse me. But DGRW is the only one to beat the S&P 500. Then what you see on the 3-year basis, very similar, and on a 1-year basis, very similar in that, again, selecting companies that haven't had to be paying and increasing dividends for a set number of years ahead of time has paid dividends over this particular environment and has allowed yourself exposure to the faster growers of dividend growth today. And ultimately, that is how we constructed the underlying index. We wanted DGRW's underlying index to be able to respond as trends change, as new payers emerge, and be able to give the investor the ability to potentially capture what's really going on in U.S. dividend markets today, as opposed to depending on sort of past behavior to dictate the overall experience that's going to be received. Another interesting way to look at it is if we take the NASDAQ U.S. Dividend Achievers Select Index, again, that VIG ultimately tracks, and we say, what are the top 20 constituents within the WisdomTree U.S. Dividend Growth Index? What we're really asking is, of these companies, which have been able to grow their dividends for 10 years consecutively and which haven't? And the remarkable thing is, as you go down the list, all the companies are big, recognizable brand names that you know and, in many cases, use products from in the United States. None of the companies are really unfamiliar or unheard of. And yet, only 6 of them are currently within the index, which requires 10 consecutive years of uninterrupted dividend growth. So 6 out of 20 are in the index that, again, requires 10 consecutive years of dividend growth. And essentially, we put the year, based on our looking at the dividend histories of each company, we put the year where we think, essentially, that 10-year mark could be hit should these companies continue to increase their dividends year over year over year as we move forward. And Microsoft is essentially the one to watch in that it may have just achieved its 10 years of uninterrupted consecutive year over year dividend growth this year. So Microsoft may be a new member in the NASDAQ U.S. Dividend Achievers Select Index at a point reasonably close in the future. But as you see some of the rest of these names, Apple included, you have to wait until after 2020 to get to that point. So just very interesting in terms of companies that may pay dividends but may not have been able to increase them year over year over year for 10 consecutive years. What we have to also discuss, and we'd be remiss to discuss it after last week with the Fed announcement, and as we look today, prior to the presentation, I was watching the U.S. 10-year Treasury go below 190, which is pretty remarkable given that it was not too long ago around 220. So if there's been one thing that we've seen this year with U.S. interest rates, maybe one word would be volatility in determining and describing what's been going on. But the interesting thing as we look here, we, in recent past, and we do this based on the inception date of our WisdomTree U.S. Dividend Growth Index, which was in April of 2013, which was kind of an auspicious time because kind of April, May of 2013, you didn't know it because we didn't have that crystal ball, but in essence, interest rates were going to go from about 1.6 to about 3% at the end of 2013. And in essence, you have this rising rate period, which set itself up, and we use sectors of the S&P 500 to show in this rising rate period from the end of April to the end of December in 2013, you had certain sectors that did very well, industrials, discretionary, technology, and you had other sectors, notably telecom and utilities, which are known more for higher current yields and less for dividend growth. You saw those sectors deliver negative returns in that rising rate environment. However, even though we announced tapering at the end of, or Ben Bernanke announced tapering at the end of 2013, and we actually tapered throughout the 2014 period, interest rates really went from essentially 3% to essentially 2%, the opposite of what a lot of people would have expected starting off 2014. So you had the counterexample. What sectors led when rates went down? And you saw utilities go from the bottom to the top of the list. We've seen it. We also saw REITs performing similarly strong. Again, it's this idea of high current yield vehicles being used to essentially help people hit their income goals when maybe bonds are not necessarily the ideal instrument to do so. If we look at what you essentially see and in exploring why this is the case, well, it's no secret that S&P 500 utility sector tends to have a much higher yield than S&P 500 information technology. We're resurrecting that average annual dividend reinvestment rate, which is just the difference between the price return and the total return. And the key thing here is not necessarily the exact numbers. The key thing is that utilities are consistently higher than the market, whereas technology is consistently lower than the market being shown by the orange line. The connection to be made is essentially in terms of correlation, namely the rolling 3-year correlation of the performance of those exact sectors that we just showed to changes in the 10-year Treasury note interest rate. And again, it fits with our intuition, namely that in a falling interest rate environment, utilities have been shown to perform better. And that's been true especially recently, and it connotes to the negative correlation that you see in blue, namely that as 10-year Treasury interest rates go down, utilities go up. And you see essentially that the market and technology, from the correlation standpoint, look ultimately very similar over the period, but both are in a position where they could behave distinctly differently than the utility sector in an environment of changing 10-year interest rates. So the bottom line is, how do we relate this to the different ETFs? And we see an array of, again, these are all dividend-focused ETFs, and the red box makes some of the biggest contrasts. So DGRW, again, focuses on dividend growth. It doesn't have any past requirements for dividend behavior, versus DVY, which is on the opposite end of the spectrum, focuses much more closely on dividend yield. The amazing thing is people should know that it's 36% weighted to utilities. So should rates continue to fall or stay at these exceptionally low levels, that's one thing. But if people do believe that we're going to go into a more normalized interest rate environment, it's worth noting. It's worth noting that there is a dividend-focused index out there with more than a third of its weight in utilities, which served it very well last year, but may not necessarily serve it as well in the future. And then you see also the big difference in technology. Again, new payers haven't necessarily been around for 5, 10, or 20 years paying dividends. You see, again, DGRW, 18%. A lot of these indexes over here that require past dividend growth or focus more on yield do not have anywhere near the same degree of technology exposure. And if we kind of do a live test of performance of actual ETFs in these environments, well, on the one hand, you had essentially the growth doing very, very well over on the left in the period of rising interest rates, the yield not necessarily performing as well. You see DGRW, which is the blue bar all the way to the left, DHS, which is the WisdomTree vehicle focused more on yield, the high dividend fund from iShares, HDV, as well. I mean, yield was not what you wanted to focus on in a rising interest rate environment, but in a falling interest rate environment, the picture was completely changed. DHS, which again, the WisdomTree vehicle focused on yield, does exceptionally well, leads the way. iShares Select Dividend Fund also does exceptionally well. That utilities weighting certainly being helpful, but you can see in terms of being able to outperform the market, the interest rate environment has been critical. The nice thing about DGRW is that even though we've had a period since its inception where rates have gone down and we've had a period where rates have gone up, overall there's been distinct versatility. What we mean to circle here when we circle the 70% is we went into Morningstar, we said over the full period of available data, if I take all the large blend, large growth, and large value active managers listed in the United States, how did DGRW do against them? It beat 70%. It beat 70% of more than 4,500 managers. So that shows that the methodology, even in a mixed interest rate environment, was able to exhibit some versatility, which is nice to see. Additionally, if you want to think in terms of some behavioral finance, you want to illustrate what might or may not be expensive in U.S. dividend markets, one way to look at it is this chart that we do with Ned Davis every quarter, where in essence we take the top quartile of dividend yield from the S&P 500, the top quartile of dividend growth from the S&P 500, and we subtract the median forward PEs of high dividend growers minus high dividend yielders. Blue means dividend yield is expensive. Currently, what have people been doing? They've been saying, I want dividend yield because I can't get it in bonds. That pushes the price of dividend yield up. Today, dividend yield is almost as expensive as it's ever been since 1981, a remarkable period of basically 35 years. So if people are asking us today, where is the value in the dividend-paying market, what I want to do is I want to emphasize this particular slide right here, because this is one of the most important, if not the most important slide in the whole presentation, because we remember we've been talking about DHS, which tracks the performance of this WisdomTree equity income, and we've been talking about DGRW, which tracks the performance of the WisdomTree U.S. dividend growth. If you look at the price-to-earnings ratio, you see the S&P at 17.2, equity income at 17.0, dividend growth at 17.4. That's very, very, very similar. And yet you look at the long-term earnings growth expectations, DGRW's underlying index is higher, 9.6 versus 8.3. The dividend yield, DGRW's underlying index still has a dividend yield above that of the S&P 500, definitely not as high as equity income. And the return on equity and return on assets, well, there really is no comparison because you look and you see a 21.7% return on equity for dividend growth, and you see a 6.7% return on assets. So we think the higher quality companies with better growth expectations should be more expensive than the higher yielding companies. And yet, if you look at the markets today, that is not necessarily the case, which leads us to say as our bottom line point that we believe there could be value in these dividend grower type companies in the United States. And we believe ultimately that if people are wondering if dividends might be getting expensive, there could be a higher chance of essentially the dividend yield segment of the market becoming more expensive. So in essence, what that does is it ultimately concludes the U.S. focused segment of our presentation. We had a couple additional points to make in terms of developed international and emerging markets. And in essence, what I'll do here is just shift gears and ultimately say that one of the interesting things that we do is we run a global dividend index, 5,000 underlying securities. And in essence, it's just interesting to see where the dividends are ultimately being paid around the world. And if you weighted the whole world by dividends, you essentially get 33% weight to the U.S. If you weight by market cap, you get almost 50% weight to the U.S. That's what ultimately the pie charts are showing. The other interesting point is if you look at the column furthest to the right, you see the percentage of the market cap in dividend payers across the different indices. So you see the U.S. is clearly an outlier. It's based on the Russell 3000, ultimately saying that 80% of the Russell 3000 market cap is in dividend-paying stocks. Every other index that's looked at here, it's over 90%. So outside of the U.S., there's a wider opportunity set of companies paying dividends. but it's important because the dividend policy is different to really think about index structure. Past dividend behavior, in essence, is such that the companies have variable dividend policies year to year to year. So it's more of a payout ratio type regime. So if you try to say, oh, I want only companies that increase dividends for 10 years, that may not be ultimately the best, approach to ultimately take in that regard. It may be difficult to find companies that have increased dividends year over year for 10 years. So index structure is of the utmost importance when thinking about developed international. And the final slide that we'll go through on developed international is just looking at, again, different indexes and ETFs that track them that ultimately focus on very different types of dividend payers. PID, IDV, and DWX track indexes that are much more focused on getting a high current dividend yield. Something that we like to point out is if DTD was the beta of dividends and included all U.S. dividend payers, DWM, which you see in the top line, could be the beta of dividends and include all developed international dividends, similar to those countries and markets that would be represented within the 21 in the MSCI EFA universe. As of the last rebalance, this index, the index that DWM tracked, had more than 2,300 underlying dividend-paying companies. So remarkable market coverage focusing on dividends outside of the U.S. You don't necessarily only need to focus on dividend yield to get there. And then if we think about the other very important market, it's emerging markets. So if we think about, okay, you have certain emerging market-focused vehicles, one of the biggest, and certainly at WisdomTree, what you see is DEM, which is our emerging markets equity income, focuses on some of the relatively higher yielding dividend payers in the United States. DVYE and EDIV also focus on higher yielding dividend payers around the world. But it's important to note that, in essence, we're weighting by the dividend stream. We're rewarding firms with greater weights that ultimately increase their dividends. The other approaches don't necessarily do that. They focus on different measures of dividend yield to get there. They may have a higher current yield, but in essence, one of the things when thinking about stocks that have higher current yields in emerging markets today, it's not necessarily about all what you're selecting or what has the highest yield or what has the better growth. A lot of what's going on in emerging markets today, especially with people watching Janet Yellen, is, in essence, you're seeing some currency moves. And some of the markets with the highest dividend streams and the highest dividend yields are places like Russia, and we know what happened to the Russian currency. So as you see the performance of DEM, it's less about the efficacy of focusing on the dividend stream or focusing on higher yielding dividend paying markets. It's more about where those markets are and the currency performance that's ultimately been seen. But in essence, some of the areas best known for dividend yield in emerging markets today are also some of the areas hardest hit in terms of currency performance relative to the U.S. dollar. So in essence, that really concludes the prepared remarks. I apologize. I went a little 5 minutes longer than the time that I was looking for, but you see the summary points here. The key thing that we always emphasize at WisdomTree is when you look at dividend-focused indices and the ETFs that track them, the key thing is looking under the hood, is fully understanding whether or not the tool, because that's really what ETFs are, they're tools, the tool that you're looking at fits with the economic rationale that you currently have on the market. And we think it's absolutely essential, whether you're looking in the U.S., developed international, or in emerging markets, you have to fully understand the index methodology to therefore know if the tool you're looking at is going to perform in the way that you ultimately would like to see with regard to your dividend exposure.
Thanks, Chris. We do have some questions that came in. Thanks for asking them, those in the audience. And as I said at the beginning, even if we don't get to the question, it will be answered, so don't hesitate to ask questions on the Q&A widget. One question that seems very germane here regarding dividend growth. There's one attendee who's asking, hasn't dividend growth been artificially induced by share buybacks, in part due to low corporate borrowing rates? How do you integrate that variable into your analysis about the growth of dividends here in the States or the prospect of growth going forward?
It's definitely a very important question to look at, and as we essentially look at the ultimate dividend growth, there are kind of different components to it. So if you look at the dividend stream, which for us the dividend stream is the cash amount of dividends being paid, dividend per share times number of shares outstanding. In essence, the cash amount of dividends being paid, if that's increasing, it's telling you one thing. Companies are paying out more ultimate aggregate dollars, and we've been seeing that. So we've been seeing growth of the cash distributions of companies. However, where buybacks become exceptionally important to look at is if you're looking at dividend per share growth, because in essence, what happens then, exactly as we said in the presentation, what you have is companies reducing their shares outstanding. They might pay out the same cash amount in aggregate, but now their dividend per share growth is artificially higher because they didn't really pay out any more. They simply reduced number of shares outstanding. Their dividend per share growth looks artificially higher. It's a very important trend to ultimately be watching. Our indexes that focuses on dividend payers in the U.S. that we discussed here are dividend stream weighted. We also, it's important to note, make sure that we only look at regular dividends when we're looking to weight our ultimate indexes, because we want to eliminate the distortions that we can while still getting to the ultimate underlying exposure, that of the dividend-paying U.S. market.
Okay, thanks. I think we have time for one more. Kind of in a similar vein in a way, if you measure dividend growth based on the price of stocks, isn't it misleading when stocks are in the trough of a market correction when you're taking that measurement?
So the way in which ultimately we look at it is if we're looking at something like the price to dividend ratio, which we positioned on the slide. Of course, in the components of that, the price can be moving, and at times the price could look fairly low. But in the U.S., you can kind of compare the U.S. to emerging markets. On one hand, you've got the U.S. where dividend growth has been exceptionally strong, so strong that in essence you could make a case that the market has gotten slightly less expensive over the last 7 years, as we saw. But on the other side, if you use dividend yield only as a valuation measure, what ended up happening was you ended up with weights in Chinese banks, Chinese financials to be particular. You ended up with weights in Russian oil companies. And in essence, there's no arguing that there could be some real deep values to be had there. But in essence, it's the type of thing where you don't necessarily know, because of the other variables in play, if those positions are going to really bear out, at least in the near term. So I think you're exactly right to point out that if dividend yield is the only thing that you look at, it's not the only thing we look at, but if it is the only thing being looked at in a particular market to talk about valuation, there could be some distortionary impacts.
Great. Unfortunately, that's all the time we have for today's webinar, Dividend Yield versus Dividend Growth, the changing face of dividend strategies. As a reminder, we'll have 3 more webinars this week in our Generating Income series. We'll get into share buybacks tomorrow, appropriately enough. That came into focus a moment ago. Also, how to get more yield in traditional bond portfolios on Thursday. And then finally, on Friday, we'll conclude with a close look under the hood of the highest yielding ETFs that are on the market today. Chris, thanks for being here, and thanks to the audience for attending. And on that note, on behalf of my guest from WisdomTree Asset Management and my colleagues at ETF.com, I'm Ollie Ludwig, wishing you all a pleasant afternoon.